Hello, good morning, and thank you for joining BDO's 2016 Budget Analysis webinar. I'm David Brooks, a tax partner at BDO, and I'll be hosting this morning's webinar. Before we get started, there are a couple of housekeeping rules to be aware of. First of all, the webinar is being recorded, and we'll be posting the presentation onto the BDO YouTube channel shortly after we've finished. All attendee lines have been muted. If anybody wishes to ask any questions throughout the presentations, there is a Q&A box on the right-hand side of the screen. So please use this facility to pose your questions to the panelists. We'll deal with some of the questions as we go and the remainder at the end. If we don't manage to cover off your question, then we'll get back to you as soon as possible after the webinar. If anyone's having any audio problems and can still hear me, please ensure that your computer's volume is turned up first of all. And if you wish to use the dial-in details, please click on the phone icon on the right-hand side to listen through your telephone. Okay, so let's get started. You can see the agenda there. I'll start by covering some context behind the budget, and then we'll introduce some speakers to cover the various areas of personal tax, business tax, and so on. So first of all, the context for the budget 2016. Since the autumn statement, which was only in November 2015, a few months ago, there's been a slowdown in the global economy, particularly in China and other developing countries. We've also seen some heavy losses on the UK stock market this year, which has cast a shadow on the UK economy. But the Chancellor has committed to balancing the budget within 5 years. As he puts it, the country needs to live within its means. And so austerity measures and overall tax increases were expected in this budget. In November, the GDP growth for this year was expected to be 2.4%, but this has now been reduced to 2% for 2016. Next year is expected to be 2.2%, which was down from 2.5%, and 2018 is expected to be 2.1%, which is down from 2.4%. So we do have a backdrop of a reduced GDP. It's worth noting, of course, that the government can still borrow at historic low rates of interest. And finally, the Chancellor pointed out in his speech that all the forecasts were based on the assumption that the UK remains in the EU. We know there's a referendum on the 23rd of June 2016, and so this could add some uncertainty to the picture. Now, when we polled our clients prior to the budget, the message that came back, what they wanted to see was simplicity, fairness, and certainty. So was this achieved in the budget? Well, I'll leave you to judge. My only clue is perhaps not simplicity. But I'd like to hand over now to Mark Ward, who's going to cover personal taxes.
Thank you, David. Okay, let's start with this year's increases to personal allowances. Under the coalition, the Chancellor set out an aim to increase the personal allowance to £12,000 to take those on the lowest incomes out of the income tax system altogether. This year's budget announced the next step towards that, with personal allowances increasing to £11,000 next year and to £11,500 from April 2017. That, combined with the increase in the higher rate tax threshold to £33,500 from April 2017, means that individuals will be able to earn up to £45,000 before paying the 40% higher rate of tax. There's a complete change to dividend taxation coming in from 6th of April 2016, with rates of tax actually increasing for people. Certainly, individuals who are owner-managers of their business should be looking at possibly paying a dividend before 6th of April so that they pay the lower rates of tax for this year rather than the higher rates of tax for next year. These are the NIC changes for next year. I won't go through these except to point out two particular interesting things. Class 2 national insurance, which is paid by the self-employed, will be abolished from April 2018, and all contracted out rebates cease on the 5th of April 2016. Other allowances, there's no changes this year. The big announcement, of course, was the new lifetime ISA which will be introduced from April 2017. This is intended to help save for people's first homes and or retirement. It doesn't have to be used for that, but the government top-up of 25% of savings will be reduced if you withdraw money for other reasons. If you've opened a Help to Buy ISA, that can be transferred into the new Lifetime ISA from 2017. This is obviously good news for first-time buyers. The big question, though, is whether this is a precursor to a whole new method of saving for pensions. Moving on to pensions, there's no new changes announced in this year's budget, but it's worth pointing out that the annual allowance is being reduced for those on incomes of over 150,000 from 6th of April 2016. There is a window of opportunity now for people to top up before the 5th of April 2016. There are changes also to the taxation of buy-to-let properties, which has obviously been booming lately. Wear and tear allowance is abolished from the 6th of April 2016, and interest relief will be restricted in phases from 6th of April 2017. There's also increases in stamp duty for second properties, and that applies to all second properties, not just buy-to-let. There's also big changes in capital gains tax rates this year. With effect from the 6th of April 2016, individuals, trusts and personal representatives will pay a new reduced rate of capital gains tax. The basic rate is reduced from 18% down to 10%, and the higher rate from 28% to 20%. Now, this applies to all assets except residential property and carried interest. The rates of tax for that type of asset will remain at 28% and 18%. There are rules coming in on mixed-use property, which doubtless will be very complicated. Another big announcement was the extension of entrepreneurs' relief to long-term investors. This is a new relief for individuals who are not employees or office holders, who will be able to pay a reduced rate of 10% capital gains tax. Details are going to be in the legislation, which will be published next week, which obviously we'll be looking at very carefully. It would be nice to see a carve-out for business angels, as there is in the Enterprise Investment Scheme. The Enterprise Investment Scheme actually offers a 0% capital gains tax rate, and this new scheme will sit very nicely alongside that, offering a 10% capital gains tax rate for investments in trading companies which don't qualify under the Enterprise Investment Scheme. There's also some technical adjustments to the Entrepreneurs Relief legislation. These are intended simply to correct drafting errors in the 2015 Finance Act and are backdated to March 2015. Now, I'm sure over the years we've all heard chancellors discussing tax simplification and what a good idea it would be. Well, when I started in tax many years ago, there was one rate of capital gains tax. It was 30%. Now we have 5 rates of capital gains tax and 3 different ways of accessing the 10% rate. 0% for EIS and SEIS investments, 3 different 10% rates, entrepreneurs, investors, and the basic capital gains tax rate, and it rises then to a 28% highest rate on residential property and carried interest. I'll leave it to you to decide whether this is simplification or not. Are there any questions at this point? Okay, well with that I'll hand you over to Neil Brackstone, who will discuss changes to the business tax regime.
Thank you, Mark, and good morning to everyone. As with any budget, there were announcements we were expecting and changes we weren't. The changes to the taxation of business were framed within the Business Tax Roadmap document published alongside the budget notices yesterday. This document highlighted the changes that have been made since 2010, such as the fall in the corporation tax rate and the expansion of innovation relief such as R&D and patent box. but it also set out the context in which many of the announcements made yesterday were set. The government is continuing to target the UK having the most competitive tax regime in the G20, to encourage investment, tackle avoidance and aggressive tax planning, and to create a level playing field for all businesses. With this in mind, the Chancellor made several key announcements. On corporation tax rates, he has yet again cut the main rate of corporation tax to 17% in 2020, rather than the 18% he only announced last summer. This compares extremely favourably with other G20 countries, with the US near 40%, France 33%, and Germany approximately 30%. And as we will see from some of the changes, although the headline rate of corporation tax is being reduced, the tax base, i.e. the taxable profits which it apply to, will be widened. Now, the most immediate impact on businesses will be the calculation of deferred tax, but this will affect businesses with a year end after the date of substantial enactment of the changes, which we would anticipate being in July 2016 if the changes are made as part of this year's finance bill, as they have in recent years. Now, turning to some of the changes that have widened the tax base. One of the major announcements yesterday was the proposed changes to the use of losses. The changes are subject to further consultation, but the key elements will be as follows. There will be greater flexibility in how brought forward losses generated from the 1st of April 2017 can be utilised. They could be offset against other profit streams and profits of other group companies. Therefore, it will be possible, for example, to use trading brought forward losses against non-trading income, such as capital gains, which is currently not possible. Furthermore, the ability to offset against profits in other group companies would be a big change to the operation of group relief. And these changes will help reduce the situations where losses are trapped in one company, yet profits arise in another group company, and therefore are very welcome. When it comes to the utilisation of losses, though, then only 50% of profits in excess of 5 million can be sheltered by brought forward losses. It is also proposed that the 5 million will apply to the group rather than each company, but the group would have a choice in how it is allocated across its companies. And also, for companies affected by the 5 million limit, this will impact on cash tax forecasts and potentially the recognition of deferred tax asset on losses. It will be very useful to see more details to understand how these rules would operate in practice, but they are a fundamental change that we've not seen for a number of years. A rule limiting the utilisation of losses by banks, which is similar to this, was introduced in 2015, so that only 50% of profits can be sheltered by brought forward losses. And the Chancellor announced yesterday that this is being reduced to 25% from April 2016. Turning to BEPS, the roadmap published yesterday also summarised the changes being made in response to the OECD base erosion and profit shifting action plans that were recently published. There's continued work to update the definition of permanent establishments to reflect modern ways of doing business. Finance Act will also legislate to address hybrid mismatch arrangements. This is where multinationals use certain cross-border structures to exploit differences between the tax rules in different countries. So, for example, where two tax deductions are taken for one payment, or where a payment generates a tax deduction, but the income receipt is not taxed. Finance Act, as anticipated, also announced the amendment of the patent box rules to introduce the nexus concept, which will link the benefits of the patent box more closely to R&D investment carried on in the UK. 2 or 3 of the BEPS action plans also related to the update of the transfer pricing guidelines, and it was announced that the 2016 Finance Act will bring these revisions into UK law. Following on from the BEPS initiative was also announcements regarding the tax deductibility of interest, which can be used in aggressive planning to to erode the tax base of a company. Now, the UK has historically had generous deductibility rules, albeit subject to transfer pricing worldwide debt cap, compared to many other countries in the G20. And following the publication of the BEPS action plans in November, and a consultation document issued by HMRC in January this year, the government has announced they will move forward with legislating new restrictions which will apply from the 1st of April next year in 2017. Now again, the rules are subject to further consultation, but they are anticipated to apply where the UK net interest expense is in excess of 2 million. And where they apply, the restrictions will be as follows. A tax deduction will be limited to 30% of the UK group's EBITDA, and as it's recognised that some groups may have higher gearing than this due to genuine commercial purposes, there will be a group ratio rule based on the net interest to EBITDA ratio for the worldwide group. And also, the rules will be introduced to cater for volatility in earnings and interest. Now, it's recognised that there will be no requirement for the worldwide debt cap rules as they currently stand when the new proposals are brought in. Therefore, it's been announced that the modified cap will be introduced to continue to ensure that the UK interest deductions cannot exceed the global group's external financing costs. To counter the use of royalty payments to shift profits from the UK to low tax jurisdictions, there will be several changes. It was announced that UK withholding taxes will be extended to include payments for the use of intangible assets, such as trademarks and brand names, unless those taxing rights have been explicitly given up under an existing double tax agreement or the EU Royalty and Interest Directive. Also, a UK domestic law will be introduced to prevent treaty abuse where payments are being diverted via conduit companies purely to obtain treaty benefits. And finally, withholding tax will be applied on royalty payments that are connected with the activities of a UK PE of an overseas company. And also now just turning to a property tax change. As part of the government's drive to create a level playing field across business taxes, they will tackle the use of offshore structures by property developers to avoid UK taxes on trading profits. Changes will be effective from the reporting stage of the 2016 Finance Bill to ensure non-resident developers of UK property will always pay UK tax on trading profits and align their position with that of UK-based developers. Now, these changes will not require the existence of a permanent establishment in the UK to give rise to a charge. Most UK double tax treaties preserve the UK's taxing right, so it's only older treaties that may require change. But protocols have already been agreed with Guernsey, the Isle of Man and Jersey. Has there any questions been raised, David, in response to the business tax announcement?
Yes, there have been a couple of questions. One question is, will it be possible to use old capital losses in a company to set against future trading profits?
I mean, that's a good question. I mean, one of the absences from the announcements yesterday was the detailed rules regarding how this would work, and that we'll welcome very much those coming in. I mean, regarding the use of old capital losses in a company to offset, I don't necessarily think that that will be the case, because they do refer to losses occurred after the 1st of April 2017.
Yeah, and I would expect would be flexibility around the use of trading losses rather than capital losses, but again, we'll need to look at the detail. Another question that came in earlier on is this a good budget for small businesses at the expense of large ones? I think, arguably, that is the case, really. There are quite a few reliefs for smaller businesses, including business rates reform, which will certainly benefit the smaller businesses more so, and obviously a lot of the targeted anti-avoidance is against the large multinationals, so I think it probably is fair to say a good budget for small businesses at the expense of large ones, and potentially you could say the mid-market have been largely left alone again, which you could view as a good thing or a bad thing, depending what the changes might be. The final question was, will EBITDA be defined in the Finance Act? Because that could well be open to interpretation.
I would anticipate that there would be some reference in the legislation to EBITDA, and if you look at sort of the way that the interaction of accounting rules and tax rules have been enacted in recent legislation, it's quite likely that the tax rules will be very much driven, I suspect, from the accounting standards and what definition is used in those, whether it will be international accounting standards or UK GAAP.
Okay, thank you, Neil.
So after now having covered off the business taxes, I'm going to pass over to Mark Seaton, who's now going to talk about employment tax changes announced yesterday by the Chancellor.
Thank you, Neil. I was explaining the purpose of the budget to my son last night, and whilst maintaining his interest for many seconds, I managed to explain that the Chancellor typically gives a bit and takes a bit. I would say that's certainly the case this year as well. Let's look at some of the main issues that arose. Employment status. At first look, it may appear that this is an area that only impacts on the public sector and is therefore not directly relevant to many listeners today. However, when we consider that the government has been conducting various consultations and introducing legislation that looks at intermediaries, and when we acknowledge that HMRC clearly perceive that the right amount of tax is not being paid, we should be mindful that these changes are unlikely to remain aimed at public sector only. The government has, after all, stated that many people find the rules confusing and there is widespread non-compliance. And public sector bodies have a responsibility to taxpayers to ensure that people working for them are paying the right tax. It's probably fair, therefore, to say that the public sector is effectively being used as a pilot, and these rules will be pushed more widely in the foreseeable future. As such, businesses will want to look at their current models for resourcing the projects from a manpower perspective and how it will account for the right amount of tax. The digital tools that are to be designed to assist in determining the correct treatment will be welcome, although I must voice a cautionary word regarding any such tool. Be aware of its limitations. Company cars. There have been continued changes to the points at which various percentages are applied when calculating the benefits in kind for car and fuel benefits. This continues this year with previously announced adjustments. And it has to be said that these changes have seen a reduction in the CO2 levels of cars, which I'm sure many of us will agree is a good thing. However, with effect from 2019, we see a considerable increase in the rate of this change, with even the cleanest cars having a 16% multiplier attached. If we look at a typical fleet car with a lease price of around $24,000 and CO2 levels of, say, 106 grams, we could have a benefit in kind of just under 5,000 as at 6th of April 2016, rising to just over 8,000 3 years later, and I've used 3 years being a common lease period, so a significant increase in the benefit in kind value. No doubt manufacturers will be working hard to reduce CO2 emissions further, but employers will also need to communicate the implications carefully. HMRC are continuing to review the area around salary sacrifice carefully. They want to ensure that, in their eyes, it isn't being abused to the point of being a simple tax dodge. Whilst personally, I see flexible benefits as an excellent way of providing different employees with different benefits based on their own circumstances, rather than simply saying everyone will have X, Y, or Z, we can still take some comfort from the budget. The government has clearly stated that they do not intend to attack benefits such as pensions, childcare vouchers, and bikes for work. So that does provide us with some assurance on these benefits. If you haven't already introduced some of these arrangements, you may wish to consider doing so. Termination payments is an area that HMRC have noted an intention to clear up some uncertainty and confusion, with various proposals planned. including changing the way that the £30,000 exemption is calculated and perhaps bringing some clarity around the treatment of contractual and non-contractual payments. However, perhaps it's not surprising that the first change that they are actually introducing is to attach employer national insurance to those termination payments which are taxable only to the extent they exceed £30,000. Historically, these payments have not been liable to NIC, but from April 2018, employers' NIC will be chargeable. Chelsea Football Club will no doubt be a major contributor to the increased NIC as they continue to replace managers regularly, but businesses generally will also need to take account the increased NIC cost that they will incur as they restructure their workforce. There's also two small changes to mention around tax relief on pension advice that may make more meaningful planning possible. For example, an increase to the amount that the employer can pay tax and NIC-free from £150 to £500, and also the option for individuals to draw a small amount of their pot, tax and NIC-free, for specific advice. Whilst these following items are not specifically arising from the budget, I have listed them here as they are coming into force from April. I'm not going to go into any of these in great detail, but will just mention payrolling benefits for two reasons. One, if you want to take advantage of this, you have to do so, you have to register before 6th of April, so we need to get moving quickly. And secondly, because the budget does actually extend the application of payrolling benefits to non-cash vouchers and credit tokens with effect from 6th of April 2017, so slightly wider scope. Are there any questions at that point? In that case, I will hand over to David Gardner to talk about changes around reward involving equity.
Thank you, Mark. Good morning. Employee tax has been made better broadly by the budget. As Mark Ward said, the reduction in capital gains tax rate of 8% has improved CGT rates. And in this slide, we're summarising the different rates that can apply to shares or shares held by employees or directors, and this covers options and direct ownership. You'll see that the top rate is just under 55%, with the bottom rate of 0%. For the typical employee, they're either holding an approved option or direct ownership of shares, they'll probably pay tax at 20%. However, where they're holding an EMI option or where entrepreneurs relief applies, they'll pay tax now at 10%. It should be noted that CGT only raised just over 1% of total government revenue. So whilst changes are important and do grab the headlines, they have very little impact on overall finances. Employee shareholder status is a new relief that George Osborne introduced in 2013. This is commonly called shares for rights, and under this, the employee agrees to give up certain statutory employment law rights in return for free shares. The key benefit was a 0% capital gains tax rate. That made ESS very popular, and there was a sense that it was being used for senior employees and executives rather than on an all-employee basis. So ESS has been limited effectively from today. New shares issued from today will still benefit from 0% capital gains tax, but only on the first £100,000 of gain. Shares that are already issued will still benefit from unlimited rights. So it's good news for ESS because it means that ESS is still viable and ESS is still available, but now employers and employees will need to decide whether it's worth offering ESS shares, given that the tax saving is effectively going to be £20,000 for the typical employee or less. As we've already touched on, carried interest for asset managers is one of the few areas where the reduction in CGT rates will not apply, so they will be subject to 28% rate, and there's also changes to change the tax treatment of some carried interest by moving it from capital gains tax to income tax treatment. This is a slide summarising entrepreneurs relief and investor relief. As Mark Ward touched on, we now have a new relief that applies to an investor in a trading company. Both ER and the new relief are very similar in that the first £10 million of gains are subject to a 10% tax rate. There are a number of questions which we'll only be able to answer once we see the legislation, but the availability of the new relief may have an immediate impact on investment decisions made by individuals, especially where those individuals are considering whether they should become a director in a unlimited trading company. If we look at the two rules side by side, to qualify for entrepreneur's relief, you need to hold 5% of the shares in the 1 year prior to disposal, and in that time you need to still be an employee or a director. For the other relief, you need to hold the shares for 3 years, and it needs to be new shares acquired from today onwards. So we are in a very unusual situation because generally employee shares have a beneficial treatment. If two people both invested in the company at the same time and both acquired, say, 2% of the company, one was a director, one was just an external investor, the internal investor, the director, would not qualify for entrepreneur's relief and would pay tax of 20% going forward, whereas the other individual, if they qualified for investor relief, would probably benefit from a 10% tax rate. So there's an element of uncertainty, but new investment decisions will have to be evaluated carefully in the light of this new relief. So a quick run through of some other minor reward changes. EMI options are very, very popular. There's been a minor change to ensure that the EMI tax benefits apply to shares acquired through rights issues. Next change is not in the budget, but applies from April. RSUs are restricted stock units, which are very popular in US-listed companies, and there's going to be some changes which will impact on how they are taxed when they're held by internationally mobile people. There's new rules which source income to UK based on your period of residence whilst holding the award. Another minor change is the loan to participators. This may impact where a company funds an employee and helps them purchase shares. In terms of numbers, the major change in this year's budget is all around tackling disguised enumeration. Government figures suggest that they are going to raise £2.5 billion through this, and interestingly, that is approximately the cost of the CGT release that they've introduced at the same time. So the planning that they are looking at in particular is involving EBTs, and historically, company has made a contribution to an EBT that's then made a loan to an employee, and that loan has been subject to a low rate of tax. There's been ongoing attempts to litigate against that, and also the legislation was changed in 2011, but planning is still being used, and it seems to, in the revenue side, it seems to be extended to being used by contractors and to fund overseas unapproved retirement benefit plans. So this is definitely a moving area, and there's still ongoing litigation involving the Rangers Football Club case, which is subject to final appeal. Yesterday's announcement contained two key changes. One is the revenue wants to encourage employees and employers who benefited from this type of planning to settle, and they are offering a better treatment if people settle before 30th of November 2016. If so, the settlement, which is effectively the amount subject to income tax and national insurance, will be based on the original amount contributed to the EBT and will ignore any investment returns. So that's a carrot to encourage early settlement. If people don't settle, the Inland Revenue intend to introduce new legislation that will bring in a blanket tax charge that will apply after April 2019. So this will probably mean that if any individual has received a loan from an EBT and either has not repaid that loan in full or paid tax on it, or their company is not settled, there will be a tax liability. It'll be interesting to see how this legislation works, because there is still ongoing litigation and the Revenue have lost a number of cases. So how the legislation interacts with that will be very interesting. This raft of changes have a clear message that the Revenue are taking active steps to combat tax avoidance schemes. Last week, the Revenue won a case involving UBS Bank in bonus planning, which is estimated to yield £100 million of additional tax. They've also stated in yesterday's budget that they will make retrospective changes to the legislation but clearly that will only take place where they consider a change to be abusive or very aggressive planning has been used. Typically, when an employer has provided a benefit to an employee and it's subject to income tax, the Inland Revenue expects the employer to pay that tax, and often if the employer is unable to pay that tax, the liability is just lost. But they are going to introduce some further legislation that will enable them to pursue the employee directly. So to recap, the main issue on EBT is going to be the settlement, either in 2016, certainly the final settlement in 2019. So, is there any questions on employee reward? Okay, so I'll pass you on to Glyn Woodhouse, who's going to cover indirect tax.
Thank you, David, and good morning, everybody. Not many significant changes to report on the indirect tax side. Headline rate of VAT remaining at 20%, slightly below average for the European Union, by only 1.5%, just about. The government did take the opportunity to make the now traditional changes to the registration and deregistration limits, effectively being increased by £1,000 to £83,000 and £81,000 respectively. No changes to the flat rate cash annual accounting scheme limits. One change that is slightly more impactful is the response to the intense lobbying by UK retailers to clamp down on perceived fraud being perpetrated by mainly overseas businesses through online market spaces like Amazon and eBay. This fraud put the non-compliant sellers at a major competitive advantage compared to UK businesses and was causing a major distortion to businesses. The way the fraud worked was for businesses to arrange for the import, often at an undervalue, or fraudulently using some other customs relief, and warehousing of goods in the UK. The sale would take place through the online marketplace to UK consumers, and the order would be fulfilled from that warehouse by a fulfillment house. The business wasn't registered for VAT, no VAT accounted for on the sale, and obviously a major distortion in price. Usually the business was overseas in a jurisdiction that was very, very difficult for the revenue to take any enforcement action against, and the tax remains unpaid. Revenue have had some small changes to their existing power to insist on the appointment of a representative who will be jointly and severally liable for any VAT due, and also their power to insist on security before they allow any VAT registration in the UK. Now, these changes are highly targeted at the abusers and should not have any impact on compliant business. But one major change that may impact on normal business is the proposed ability to hold the fulfillment house jointly and severally liable for missing VAT by the fulfillment house's customers. That's obviously going to have a major impact on the way these businesses do business, and they will have to introduce significant levels of due diligence to prevent themselves being caught up in this way. Hand in hand in this is the consultation exercise that was announced yesterday on the registration of all fulfillment houses and the level of due diligence that HM Revenue and Customs will expect them to carry out if they're not going to be held liable. Affected businesses should take a look at that consultation and seek to respond shortly. Other changes to indirect tax include insurance premium tax, that's rising to 10% with effect from October 2016. Although this is only a 0.5% rise, it is on the back of other major rises that have caused insurance premium tax in the UK to rise by some 65%. It's interesting to note that IPT in the UK is still significantly lower than many EU countries, and so further rates are distinctly possible. Some small changes to gaming duties. Firstly, the gross gaming yield bans affecting land-based casinos in the UK. They've been altered slightly. And the other change is the inclusion of free bets in the calculation of remote gaming duty by online gaming companies. The largest headlines so far have been created by the sugar levy, even though there's going to be absolutely no levy raised until 2018. My personal favourite being the Sun newspaper this morning with its headline, Fizzy Rascal, with an amusing picture of the Chancellor. This levy will apply to importers and manufacturers rather than retailers, predominantly so that the levy doesn't fall foul of the EU rules on the introduction of similar taxes to VAT. All the money raised will be used to support sport in primary schools, breakfast clubs and keeping schools open for longer, although interestingly the expenditure is going to arise in 2017 and the money raised in 2018, which could be why we got in this mess in the first place. Before I move on from talking about the traditional indirect tax arena, I just wanted to draw everybody's attention to BDO's inaugural VAT survey. This survey is focusing on the compliance burden on business and how different businesses deal with VAT within their organisations. It's absolutely fascinating, and it should form the basis of some really useful discussions on how business deals with VAT, particularly given the fact that VAT yield is now nearly 3 times that of the yield of corporation taxes. So thank you to everyone who responded to the survey, and I'm really looking forward to sharing the results with you later in April. Just a quick note on SDLT. The SDLT rules announced in the 2015 autumn statement come in, applying additional SDLT to the purchase of second homes and investment properties. There's also been some changes to the non-residential property SDLT to bring it in line with the residential one, getting rid of the slab system and replacing it with a properly banded system, obviously to be applauded. I don't think anybody really likes the slab taxes, really. Finally, I just wanted to quickly mention the Union Customs Code, which comes in with effect from the 1st of May 2016. Now, this code will have some real major changes for importers and exporters, and we would urge all businesses involved in significant volumes of export or import to assess the impact of the changes. Many businesses may need to urgently apply for AEO status if they're not going to be required to post very, very significant guarantees to access customs duty relief. The AEO process takes an inordinate amount of time, so if your business is affected, you will need to act really quite urgently. David, do we have any questions on indirect tax?
There was one question about, are there any changes to TOMS for the tour operating businesses?
I am not aware of any changes being proposed to the tour operating margin scheme. Obviously, the question is response to the Kingdom of Spain case, which seeks to look at the use of transport companies within the tour operating margin scheme. There have been no announcement on that just yet.
Okay, thank you. We have got a few other questions that we could just deal with now at the end, but thank you for all our speakers so far. The first question is regarding the potential new savings schemes for pensions. And the question is, do the panellists think there was any relevance to the Chancellor's reference to 401k schemes used in the United States? We could do with one of our US colleagues on the phone, actually. I think they're likely to listen to this later when they come online. My understanding is the reference to 401k schemes was where if tax relief is given on investing into one of the new savings arrangements and then the cash is removed, whether that would result in a loss of tax if the money was then put back in shortly afterwards. And I think the consultation and consideration as to whether the tax benefits could be retained if the money was taken out but then put back in again. But it's interesting he is referencing arrangements used by other jurisdictions, and it may well be that he's gaining some interest and influence from the tax ideas of other countries, which is probably welcome. I don't know, David, did you have any thoughts on that?
Yeah, I was just going to say that you can use a 401k account effectively as a savings account, so money can go in and out, and tax relief is adjusted as money flows in. So I guess that's what he's saying with the running investment account.
Yeah. So it could well be that he's seeking to mirror the 401k scheme in the US. There was another question about pensions advice. If an employer can pay up to £500 for pension advice per employee, is this deductible for corporate tax and not a benefit in kind for the employee? It's certainly not a benefit in kind for the employee. I understand it would be deductible for corporation tax purposes as well, so we can confirm that understanding. There was a question, is there any more information available on money boxing? I assume this is a reference to the tightening of the transactions in securities rules. And essentially, there are going to be changes attacking phoenixing, where cash is in a company, it's liquidated and paid out to shareholders with the benefit of capital gains tax, rather than being taxed as a distribution or under income tax. And so we haven't seen anything specifically new on that. There is some consultation, but obviously we wouldn't expect any watering down of those suggestions that this will be clamped down on. So I think that covers most of the questions. There are a couple of others that need a bit more detailed response, and we'll respond to those separately just after the end of the conference. So I'd like to again thank all our speakers this morning. Thank you to everyone who's also attended. Apologies to those, there were only a couple of questions we haven't answered, but we will get back to you as soon as possible on those. As a reminder, we will be posting the webinar on the BDO YouTube channel, so you can watch the presentation again if you'd like to. And remember, BDO's full commentary and analysis of the 2016 budget can be found on our website at bdo.co.uk. And you'll also find there our recent New Economy publication, in which we provided the government with 20 recommendations on how to stimulate the UK economy and to help mid-sized firms to prosper. So once again, thank you for joining us this morning. Please do contact me if you wish to discuss any contents of the presentation in more detail. Thank you.